Ladies and gentlemen, good morning. A warm welcome to our webcast on the impact of COVID-19 on transfer pricing. I hope you and your relatives are doing all fine and that so far you have survived the different challenges of working at home. I'm happy that so many of you found an interest in our webcast, which demonstrates the importance of the topic. My name is Benjamin Koch and I'm hosting today's webcast. Joining me on the panel today are David McDonald, our financial services transfer pricing leader, as well as Jan Hurdovar and Jacob Parma, both directors in our transfer pricing and value chain transformation team. The driver of our webcast is the exceptional business environment and the expected economic disruption caused by COVID-19 pandemic. The significant economic downturn will certainly affect transfer pricing. We thought it makes sense to provide you with some reflections how those circumstances may impact your transfer pricing. But how? We will hold two webcasts, one today and another one on May 8th. Both webcasts will not last longer than 45 minutes in order to keep it short and focused. We have summarized our thoughts within 6 baskets, of which 3 of them we will cover in today's webcasts, namely our thoughts on intercompany financing transactions, the impact of the crisis on various elements of your transfer pricing policy, and the influence on current litigation, advanced pricing agreements, and your intercompany contracts. But let's have a quick look on the overall landscape of the topics we would like to cover in the 2 webcasts. Number 1 to 3 are today's topics, which I have mentioned already before. Number 4 to 6 are the topics which we will cover in our May 8th webcast, which can be summarized as topics related to the potential change of your value chain, including business restructurings you may consider, and how to deal with permanent establishment challenges as a consequence of the current economic turmoil. This said, let me hand over to David to cover our first topic. David, please.
Good morning, everyone. My name is David McDonald. I'm going to talk now about intercompany financing transactions and how they may be impacted by the current crisis. Groups that are impacted by COVID-19 have 3 priorities. Their people, their customers, and cash. And the focus on cash is the basis for the first topic that we'll discuss today. Since the crisis took hold, organizations have been forecasting and reforecasting their revenues, assessing their debts, considering where they can reduce costs, looking at their funding options, and projecting their cash needs, and reprojecting their cash needs. This has immediate impacts that are relevant for transfer pricing for financial transactions, which for the purposes of today's presentation will define as including cash pools, loans, and guarantees. Let's just consider one example before we move on to the next slide. So, thinking about loans and the current crisis, the first observation that I think we would make is that new loans, new intra-group related party loans may be created as a result of the crisis, often at short notice because of the need to move financing around a group. For example, some groups will have divisions that are relatively unaffected by the crisis and divisions that are more directly impacted. They may be using intra-group loans to move financing into the parts of the business that are suffering from the parts of the business that are not. Other groups may be moving funds from the subsidiaries into the parent or the treasury centres to ensure that they meet covenants under their external financing. So just in that one area, with that one example, I think we can immediately see that the crisis is very, very relevant for related party financing transactions. Let's move to the next slide. Now, I want to cover an area that is not directly relevant to the crisis, before then returning to the crisis. And I have a specific reason for doing this. The OECD published new transfer pricing guidance on financial transactions in final form on the 11th of February this year. So everything that we do now, thinking about how to make changes or to price new transactions that result from the crisis, we need to do in the context of new and more detailed guidance than has ever existed before. So I want to take a couple of minutes just to highlight some of the things that are new in that OECD guidance that has not existed in the past in final form. And I'd also just like to remind you all that the OECD is the main body for drafting international transfer pricing guidance. Many, many countries, I would say most developed countries, will be referencing this new guidance on financial transactions. So just picking 4 areas where we have some new guidance from the OECD and running through them one by one. Let's start with accurate delineation of transactions. This concept means that in the future, tax authorities can challenge the way a financial transaction has been structured before moving on to challenging the way that the transaction has been priced. So, for example, it is now necessary to demonstrate that not only the interest rate on loan has been correctly benchmarked, but also the terms of the loan, the size, the currency, the duration, the seniority, the security, etc., are all reasonable and appropriate. If they're not, tax authority may challenge the terms first, for example, saying that a long-term loan would instead have been structured as a short-term loan, and then use that as a basis to argue that the benchmark and the pricing that has been used are invalid and should be replaced by the tax authority's own treatment. A couple of other points in here related to accurate delineation. It is now necessary to demonstrate that a transaction is reasonable from the perspective of both the borrower and the lender. Let's just think of one example there. If we have a borrower that has substantial funds sitting in a cash pool and a group implements a debt pushdown structure which involves the creation of long-term debt for that same company, it's entirely expected and reasonable that tax authority may in the future say, the perspective of the borrower, at arm's length, would it have borrowed money, long-term expensive funding, when it already had cash on its balance sheet that it was using in the cash pool to receive a short-term low return? So new tests and new requirements that we need to consider in the future. And just one last one on accurate delineation. That's the requirement in the future. The taxpayers need to demonstrate the amount that a borrower is arm's length, which means demonstrating that the borrower could have borrowed that amount from a bank or other third party, and that it would have chosen to do so rather than raising additional equity, for example, or selling part of its business. 3 other areas, very quickly, I'll just highlight some key points. For cash pools, there must be a function analysis, and there is a specific point of the function analysis, which is a focus on the cash pool leader and whether it has significant risks that it bears and whether it has significant functions that it performs. There is an expectation from the OECD that normally this will not be the case, which then has an implication for pricing within the cash pool, with the suggestion that often that will mean that cash pool leader should only receive a routine return for the activities it performs, possibly cost plus, for example, and not that it will be rewarded with a significant spread between deposit and borrower rates. That is not the way that most cash pools work at the moment, so this is important guidance. And then maybe I'll just cover one more from this slide, which is guarantees. There is now very clear guidance from the OECD about when a guarantee fee should be paid and when it should not. And that is great news because this has been an area of uncertainty for some time. There are also a number of alternative methods that the OECD talks through and gives guidance on for pricing guarantee fees. So also some welcome news on the pricing there too. Let's move to the next slide and just talk about a few things that are happening in the market at the moment that will have an impact on financial transactions within groups. So the first area is access to funding and impact on funding costs. The first thing that I want to recognise there is some groups will be obtaining additional funds in the market now to ensure that they are and that they continue to be liquid. The interest rate they pay on those funds, the terms that they agree on those funds may be different to the terms and the interest rates on their existing funding. So the cost of funding to the group may change, but also what constitutes an arm's length term may also change. And that becomes relevant context, either direct relevant context because the external transactions are benchmarks or inputs into the calculation of internal transfer prices, or just indirect context on the general market environment that are relevant to internal transfer pricing. And the last one that I'd highlight from this slide is government intervention. Many governments are allowing taxpayers to borrow at preferential rates with little security. What does that do to a group's cost of funds, if that's the basis for transfer pricing? Is the government low or no interest rate a benchmark that taxpayers should consider when setting their related party transfer prices? Let's move to the next slide and highlight some of the challenges in a little bit more detail. Now, the first thing I want to say here is we need to be practical. So in principle, group tax right now should be partnering with group treasury to understand the existing pool of related party financing transactions and all of the new intra-group financing transactions that are being established. And that is the recommendation where possible. But where possible is the key two words in that sentence. And the reason I say that is the groups that are likely to have the largest impact on their related party financial transactions are also the groups that are likely to have the biggest treasurers, biggest impact on their treasurers right now. And those treasurers may be working absolutely flat out to renegotiate external financing arrangements and to forecast and reforecast cash flow needs. So I will talk through each of the issues that we would like to highlight to you here, but I would like to make that practical comment first. Some groups will be able to deal with these issues now immediately from a tax and transfer pricing perspective. Others may want to only get involved in Treasury on the biggest new transactions and then clean up the transfer pricing for the rest of the related party financing arrangements somewhat later in this year when the business environment has stabilized. Okay, now let's move on to the points. So accurate delineation, I mentioned that earlier, that's a new requirement from the OECD. Any financing decision now should take into account current economic conditions, which means that what an arm's length set of terms for a related party loan look like now may be different from what is set out in a group policy that was documented a year or two ago. It's also important to consider creditworthiness and how that may impact the pricing of intercompany loans. Creditworthiness is approximated by credit rating. Credit ratings based on a number of inputs which include profile of revenue and profile of profits, value of assets that a company holds. There will surely be, in many of your groups, some group companies that have seen their revenues fall or have seen the value of their assets decline. And one or two, and hopefully many, that have seen the size of their revenues increase and possibly the size of their assets grow. They will have an impact on credit rating, which is relevant both for the interest rate on a loan, but also the amount that an entity could borrow. And let's think about options realistically available to group companies. And that could include looking at existing loan agreements and whether at arm's length they would be refinanced, either because that would be demanded by the borrower or more likely the lender if the borrower is in some financial distress. And the other question, which I think is really key in light of the current environment, but also the new HD guidelines, could a borrower really have borrowed this amount on these terms at arm's length? I think that's a question that has traditionally in many countries been dealt with by thin cap legislation, but is now also a transfer pricing test is going to be a key test that we're going to have to think about quite a lot at this time. Let's move to our next slide, just look at 2 or 3 other areas that may be impacted. A very obvious one is the cost of borrowing. Government base rates are coming down. That's great news. They've come down very, very quickly in some markets, for example, the US, but credit margins and yield curves are widening. Long-term financing is more expensive than it was. Entities with lower credit ratings will pay more than they previously did, at least in terms of a margin. And what that means is that benchmarks need to be current. It was previously reasonably widespread practice when using loans as benchmarks to select loans from the last 6 to 12 months before a transaction took place. That is no longer appropriate. A loan benchmark from 6 weeks ago, let alone 6 months ago, is already fairly obviously out of date. So the first comment, or 2 comments here really, cost of borrowing, it's likely to be higher in most instances. Benchmarks need to be up to date. It may even be necessary to update a benchmark between the time of pricing a transaction and the time that the transaction was actually executed. But these are all manageable challenges, and as with all things transfer pricing related, and particularly all things intercompany financing related, what is right for a $1 billion loan is not right for a $1 million loan. So for a $1 billion loan, absolutely the loan benchmark has to be updated. For a $1 million loan, a degree of practical common sense is all that's required. Government stimulus is the next point I have on the slide, and it creates some obvious challenges and some less obvious challenges. I covered the obvious challenge when I covered external environments a couple of slides back, but a less obvious challenge. If a group has 2 business divisions, one of which is profitable and continues to be profitable, and another that is severely impacted by the financial crisis and what's happening in the market and what's happening to demand, but overall the group is liquid and decides from a reputational perspective it does not want to take advantage of government stimulus and government measures because of the worry about what that will do to the group's reputation in the future. What does that mean for the division that's in poor financial position? Should it still pay market rates for loans that it receives from the parent or from the more profitable division? Should it only pay what it would have paid if it as a standalone group had been able to access the government stimulus? And if it does that, who bears the cost? For the moment, I'd say they are interesting questions, and I think that groups that have that as a set of issues will need to work through them one by one. Okay, last area from these slides, guarantee fees. First comment here, external lending institutions are more likely to be requesting group guarantees than they were in the past, so I think we're going to see more of these transactions than we did previously, and we have new transfer pricing guidelines for assessing them. Now, I'll talk briefly on this next slide about cash pools and treasury centres, and I'll talk about cash pools because they are the most common form of intercompany financing that we have within Swiss headquartered groups, and also they are very easy to adapt at short notice to the need to move money within a group. And what that means as a first implication is many groups may see that the volume of the balances in their cash pools have significantly increased in the last month or 2 months as a result of the crisis. So transactions that maybe would have been immaterial or medium-sized in the past may be large now and may need more focus than they did previously. And that in the light of the OECD guidance that has really changed the landscape for cash pools and how transfer pricing is established. On top of that, I'll just highlight 2 points. The deposit rates in lots of cash pools are set at or very near to country base rates, often LIBOR interbank base rates. And while the Swiss franc and euro base rates have been low, very low, even negative for some time, base rates in other currencies, particularly the US dollar, have not, and have come down very substantially in the last 6 to 8 weeks. So groups where the cash pool leader has excess funds will find that the cash pool leader has a real drop in income in the cash pool, and that may make the leader structurally loss-making in a time where the OECD says that a cash pool leader will normally be recognized as being low risk. There is a contradiction between those two statements, so there is something that needs to be looked at there. Likewise, on the other side, cash pools that are structurally short of cash will find that they're paying more on overdrafts from banks to top up that cash. And again, that may make them structurally loss-making. So it is important, I think, to look at cash pools now, particularly where balances have substantially increased. There is an opportunity to adapt quickly, both to the OECD guidance and the market developments in one exercise rather than two. And for those of you that like to see the world as being glass half full, I think that's a real opportunity. So let me wrap up with my final slide where I talk about a few recommendations. And my first recommendation is, I think everyone in group tax and transfer pricing, whoever has responsibility for transfer pricing within your groups, should be in touch with Treasury enough to understand any new large related party financial transactions that are being introduced. And those large transactions should be evaluated immediately. And also, any existing large transactions should also be looked at. Do they still make sense from the perspective of the borrower and the lender? Is there an opportunity for tax efficiency or just from good cash flow management to modify those transactions? Within this year, groups should also review all of their related party financing transaction policies and whether they're compliant with the OECD guidance. Groups that have less business stress as a result of COVID-19 may choose to do that later in the year. The starting point, I would suggest for all groups, is a fairly small exercise, a gap analysis, to see where the gaps lie, to determine whether they're material and whether they need to be fixed, and only afterwards to do the remedial action where it's required. At that point, I will stop talking about financial transactions and I will hand over to Jan, who's going to talk about the impact of the crisis on other areas of transfer pricing, policy, benchmarking, and exceptional transactions that arise. Jan, over to you.
Thank you, David. Thank you to the audience for tuning in. Let's dive straight into the topic by looking at transfer pricing models. In these turbulent times, loss-making businesses are realizing that their transfer pricing models have been designed usually for times of economic prosperity. Let's take a common example. Companies which have entrepreneur limited risk models are facing challenges on how to allocate their losses within their groups. Over the past few weeks, some of the common questions you may have faced are as follows. Should the principal bear all the losses, given that it earns the residual profits in good times? Another interesting question is, can the target profit margins of limited risk distributors or contract manufacturers be lowered? One of my clients rightly pointed out to me that limited risk does not mean risk-free, when arguing that he wanted one of his LRDs to make a small loss in 2020. All these relevant questions impact directly your group liquidity and effective tax rate. So what can you in the audience do to address these numerous challenges? A good starting point is to analyze your intercompany contracts. Over the past few weeks, we have seen plenty of examples of third parties renegotiating their contractual terms on pricing, volume commitments, payment deadlines, and various other terms. These third parties are activating built-in clauses covering renegotiation of terms, force majeure, unforeseen circumstances, fairness, and many other types of examples. So what can you in the audience do to translate these third-party examples to your own intercompany situations? The second step you should consider is to perform a functional analysis with a specific focus on the conduct of the parties when controlling key business risks. For example, which party is responsible for deciding on how to reorganize the supply chain? Are workforce redundancies being decided by central or local management? All of these are valid questions you should be assessing as part of an in-depth functional analysis. Once you've completed these two steps, the third step is to then implement the change in transfer pricing policy. For that, you could either choose to amend your intercompany agreement. Alternately, one of the options some of our clients have been testing is to put in place a memorandum of understanding whereby the parties acknowledge that given the prevailing crisis, they mutually agree to apply revised contractual terms which deviate from their current intercompany agreements. Now that we have a better conceptual idea of what it takes to change transfer pricing policies, let's take a closer look at comparability analysis. This will be crucial both in setting revised arm's length pricing, but also in defending deviations from pre-crisis transfer pricing policies. Currently, when we speak to companies, one of their main challenges is that their existing benchmarks do not reflect the COVID situation. In fact, these benchmarks have two main flaws. Firstly, they reflect profit margins to be achieved during times of economic prosperity. Secondly, they are often a one-sided reflection of what profitability should be for limited risk models, without due consideration to the overall profitability achieved by the group across the entire value chain. To compound these comparability issues, bear in mind that benchmarking data reflecting the COVID crisis will only be populated in commercial databases in late 2021, early 2022. Further, there is no guarantee that these benchmarks will fully reflect the impact of a crisis, as some companies will likely go out of business. What can you do about it? Let's, for example, look at some of the comparability adjustments you could consider. The first one is really going back to the source. You may have your own cases where you're renegotiating contractual terms with third parties. These are probably the best basis you can find in terms of adjusting your own intercompany policies. The second option you could consider is statistical regression analysis. At PwC, we have started helping companies, some of you in the audience most likely, adjusting their benchmarks by translating to the current crisis the same type of profitability decreases we had observed for specific activities or industry sectors during the last economic recession in 2008, 2009. A third option is to adapt the benchmarking strategy. It could be that we look for subsets of comparables, which are more in line with your type of business in terms of how impacted it is by the crisis, or potentially looking at testing the margin of your tested party over a different economic cycle. A fourth option, which you might consider, is to perform a value chain analysis to determine a more reliable allocation of profits as opposed to relying on one-sided benchmarking exercises. Whatever course of action you take, always think of documenting the changes and why you're making such changes. In whatever example of comparability adjustment we've seen, whether it's over the last financial crisis or as part of more recent audits, an ex-ante analysis set to revised and arm's length pricing is far more robust than doing an ex-post analysis, which is done after the fact to justify why you're deviating from a transfer pricing policy. Let's move to the next topic. Whilst comparability analysis will help support the transfer pricing model in ordinary business activities, many of you will recognize that you also face the case of extraordinary expenses. Some of these are quite substantial. What can you do about this? The first step is to analyze your existing documentation to see to what extent these explicitly cover extraordinary expenses. It could be intercompany agreements currently in place, or it could be your transfer pricing documentation, whether it be the master file or the local file, which describes the role of the parties in dealing with events leading to such extraordinary expenses. If your documentation is not helpful, consider performing an in-depth analysis focusing on the following: the nature of the expenses, which parties are responsible or in control of your extraordinary expenses. And the third step, once you've determined the reasonable allocation methodology you want to implement for your expenses, remember that the best way forward is to put in place a detailed documentation. A contemporaneous audit defense file will go a long way to demonstrate the arm's length nature of any allocation you choose to do, especially when you have to speak to your statutory auditors and also as part of future tax audits. To conclude, here are my 4 takeaways. Firstly, be proactive in adapting your transfer pricing policies. Third parties are doing it, why not you? Secondly, start with your intercompany agreements and then broaden your analysis. Thirdly, keep in mind that there are a number of ways to adjust benchmarks. Make use of them. And last but not least, document and substantiate any changes you do, as these will come in handy as part of dealing with future tax audits. On this note, I'm pleased to hand over to Jake, who will speak in more detail about APAs and challenges you may be facing regarding these APAs as part of the COVID crisis.
Thank you, Jan, and thank you to the audience for joining us today. Now, I will briefly share some of our experiences and insights from the recent weeks on how the current situation affects tax and transfer pricing controversy, advanced pricing agreements, as well as your intercompany agreements or agreements you may have with external third parties. As we all know, the environment for multinational enterprises, both market and regulatory environment, has been dynamic enough over the last 12 months, even without the COVID-19 impact. The transfer pricing models that groups apply internally or agree with tax authorities as part of advanced pricing agreements are based always on a number of critical assumptions and parameters, be it market-driven or your internal operations-driven. Such unpredictable and volatile black swan events, such as COVID-19, put a lot of pressure on both taxpayers and tax authorities who need to adjust. Some industries and businesses that are most severely impacted by the current situation need to adopt quickly and need to react fast to make sure that they address the most urgent needs. From a tax controversy, tax litigation perspective, for transfer pricing right now, we see a certain delay, postponement of activities related to ongoing litigation, as well as discussions of rulings and advanced pricing agreements. But what we expect, and this is also based on prior experiences, after an initial adjustment period, the tax authorities will quite likely increase their tax collection efforts in order to obviously collect tax revenues that will finance the various government help and stimulus programs. Altogether, this obviously results in a volatile and changing environment for both the taxpayers who need to either set or manage the transfer pricing models and how the tax authorities approach you. From an APA, advanced pricing agreements perspective, this is a particularly relevant topic because of the nature of APAs, which are usually long-term agreements, approximately 5 years in duration, that multinational enterprises enter in order to achieve agreement and comfort for the future financial years with the tax authorities. These agreements are based always on a number of parameters and critical assumptions, which you discuss, agree, and are expected to follow. Any sudden and unpredictable change to your situation, such as COVID-19, may require you to act fast and change how your business operates and how your transfer pricing model is applied. From an APA perspective, if these changes result in a sufficiently material deviation from the APA parameters and critical assumptions, these may invalidate the APA. Now, from a practical perspective, changes to APA parameters and critical assumptions are possible, but often require time. This is why, particularly right now, we advise and work with a number of our clients on a proactive approach towards assessing whether there is a need to address their APAs with the competent authorities. Such proactive approach on a pragmatic level is highly appreciated. This is also the experience we have made during the global financial crisis. From a perspective of the options you have to manage your APA situation, usually an APA agreement will have a force majeure clause that may be invoked in specific circumstances. This, however, carries a relatively high burden of proof and is quite fact-specific, so it needs to be really closely analyzed before you decide this is the preferred course of action. There may be potential for renegotiation of certain APA parameters, either linked to the underlying market data that was used or is being used, as well as looking at the timing of impact that is relevant in your specific case. This may be an urgent need for a short-term change, or your situation may allow for a certain time to take and have a look at the full picture of the impact of COVID-19. Also, and this is what both the taxpayers and tax authorities are looking at, is the immediate impact and disruption COVID-19 has created versus the expected impact of the government stimulus programs. As mentioned, tax authorities, competent authorities who are responsible for APAs, are open for discussions around the APAs. They've expressed it to us in recent discussions. There may be even potential to renegotiate with them how the past closed financial years under specific APAs are to be treated. Overall, competent authorities view the situation as developing, and while they understand and accept that certain taxpayers will have an urgent need to act right now, they themselves are adopting a wait-and-see approach to decide what really is the impact and how this can be addressed as part of the APA processes and the APAs themselves. From an intercompany agreement perspective, even if this is a transfer pricing model that has not been agreed or ruled as part of an advanced pricing agreement, the unpredictability of events such as COVID-19 may have a material impact on the assumptions that you have taken in order to conclude those agreements, and legal agreements are a fundamental part of your transfer pricing model. Whether it's the impact on margins and their volatility, or the pure fact that COVID-19 impact results in certain counterparties to agreements not being able to perform the foreseen functions, or being suddenly allocated with risks that they do not have the capacity to carry or control. These are some of the examples that already now drive a lot of our clients to revise immediately their intercompany agreements. In such cases, the typical ordinary termination clauses may not allow for sufficiently quick reaction time. There is usually an urgent need to change, which in that case may require usage of hardship or force majeure clauses. These ones can be used to address the situation, but obviously require a more detailed and comprehensive approach to verify to what extent they can be used. What we have seen is that a targeted analysis can usually help a group find the right approach to managing both the financial and operational impact of the external shock that currently is COVID-19. I will be happy to take any additional questions you may have on this during our Q&A session or following our webcast. And right now, I will hand over back to Benjamin for wrap-up.
Thanks, Jake. So let's quickly wrap up. On financing, the current situation has put a lot of stress on your organization's financial and cash position. You had to act very quickly, and time has come now to address your immediate action and to sort out the respective intercompany financing relationships appropriately. You may have additional or changed or still the same transactions, but the cost of borrowing and the extreme volatility in today's environment needs to be taken into consideration. In addition, besides the COVID-19 impact, we also have new OECD guidance on the intercompany financial transactions, which have to be addressed. However, have a look first at your inventory of intercompany financial transactions, triage them, and focus on the most relevant ones. On transfer pricing policies, we looked at a situation where we must deal with value chains which might be entirely in a loss position. Is a limited risk distributor a distributor without risk? Or should he participate in a partial assumption of losses? What about the scale down of the manufacturing activities? Let's analyze the intercompany agreements and discuss the flexibility provided therein, and certainly document appropriately what you have done. This is also true if you apply a different approach to benchmarking, given the impact of the current circumstances on your benchmarking studies, and or have a look how you deal with third parties, given the special circumstances, and derive a potential behavior for your intercompany transactions. Talking about controversy management, make sure you're up to speed from a formal perspective, particularly with respect to deadlines. Make sure you understand the impact of the current situation on your ongoing cases. If applicable, think about how you would like to deal with your commitments in advance pricing agreements. Do you want to renegotiate, at least for a certain period? The financial crisis a decade ago has shown that competent authorities are willing to find solutions. Last but not least, and we quickly mentioned it above already, a critical review of your intercompany agreements, whether or not you have hardship or force majeure clauses, can certainly be worthwhile to adjust your intercompany pricing, but also provides you an indication on how in future some of the clauses in your intercompany agreements need to be drafted to give you some certainty. With this wrap up, we come to an end of our presentation, but are of course open to your questions. Before we jump into Q&A session, please let me remind you that on May 8th, we will have a second webcast on the topics I mentioned at the very beginning, namely topics which are related to the potential change of your value chain. Via the next slide, we invite you to participate in your Q&A session. Please provide your questions via the Q&A button, and we will address them accordingly.